Hello, I'm Jeff Jr. with Trajan Wealth, and it has been a wild ride with the market volatility these past 12 months. Now, if you subscribe or follow us, then you know that we've been watching the markets while keeping an eye on your long-term goals. And if you haven't subscribed, what are you waiting on? Take a second to do it. We're always here to answer your financial questions. Now, if you're close to or in your retirement, then this volatility could definitely keep you up at night. I know it has me. Now, after all, no one wants to sell their stocks when they're down 10, 20, or maybe even 30%. Now, traditionally, bonds fill that need for stability. They are conventionally safer investments that diversify your portfolio, and they provide a buffer against market volatility. Plus, there's a return to boot. However, it used to be a lot better. So today, we're taking a closer look at bonds, the types of bonds, and their overall returns. Now, first off, let's start with the basics. Bonds are issued by governments and corporations when they want to raise a little bit of money. Now, by buying a bond, you're simply providing a loan, and they agree to pay you back the face value of the loan on a specific date and pay you interest on top of that, just like a loan you may have with the bank. However, the rates these days are much lower than they used to be. So, are they even still a good investment? The short answer is, like so much in life, it depends. So let's take a look at the types of bonds more closely and answer which ones are still worthwhile to own. Now, you might know the major types of bonds, which are government, municipal, and corporate. Now first, let's discuss government bonds. These are debt securities issued by the government to support government spending. Now, because the US government backs them, US Treasury bonds are considered nearly risk-free and are the safest in the world. Now, the pros of government bonds? They provide a steady stream of interest return to the bondholder with low default risk. The US government is not going out of business anytime soon, even though I know some of you wish they would. The income from these bonds are also generally exempt from state and local taxes. But low risk means lower returns, right? US 10-year government bond interest rates are about 0.81% right now. Compare this to 1.81% just last year. This is much lower than the long-term average, which has been 6.05%. Ouch, huge. That rate won't even beat inflation right now. But the pro is, it's safe and provides more than typical savings accounts do these days. An alternative is municipal bonds, also called munis, which are debt securities issued by state and local governments as loans for public works projects. Now, these are generally more attractive because they can provide tax-advantaged income. The interest paid out by these bonds is not subject to federal tax and is sometimes exempt from even city and state taxes. And the yield can be a little bit better too. The yields for some of the lower-rated investment-grade municipal bonds, meaning they're rated usually in the B range, give or take, with an average of 10 years until maturity, now are about 2% to 2.25%. However, the default risk can obviously be much higher. Think about the hit that some of these states are taking to tax revenue simply because of this pandemic. That's why professional portfolio managers are so critically important at this time to find the right ones. Now finally, let's discuss corporate bonds. These are debt securities issued by companies to raise capital, often for a project of some sort. Now, one advantage of corporate bonds is their high liquidity. These bonds trade on the secondary market, or just the stock market, meaning you can buy and sell bonds after they're issued for better profits. There are also many options when investing in corporate bonds, like short-term and long-term options, and when they even pay you. That's typically semi-annually or annually, and is called a coupon structure. Now, I know I'm getting a little bit deep, so I'll stop. High-rated corporate bonds are also typically less risky and volatile than common stocks. But again, keep in mind, the lower risk the company, it also means a lower reward. Corporate bonds and munis are much more attractive right now than government bonds. However, even though they're not paying as much as their historical norms have been. Now, so what's our take? There are no easy answers in the low-rate world that we're living in. You can either earn less income to protect your capital better, or earn more income but accept more risk in your portfolio. The right answer will ultimately vary depending on your financial situation. Your retirement goals, your age, and your risk tolerance are all factors that need to be considered to even decide if bonds are right for you. So, in closing, come to Trajan Wealth. Our fiduciary advisors will help you decide which bonds are the right fit for your retirement plan, if at all. We'll assess your situation and find the right solution that is right for you. So give us a call. We're here to help. So in the meantime, I'll see all of you next week.